and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today is Ben Poole, writer at CTMfile. Welcome, Ben, to this episode of the Open Treasury podcast.
Thanks, Push. Great to be here.
Thank you so very much for taking the time to share your thoughts with us on topics that impact the world of corporate cash and treasury management. In today's edition, we shall discuss 4 topics, namely the big 5 economies back global nuclear supply chain, Europe reaches a deal on Artificial Intelligence Act, the Bank of England and the European Central Bank keep interest rates unchanged, and finally the 2024 outlook is projected as neutral for global money market funds by Fitch Ratings. Our audience can read articles, interviews and industry roundups by visiting ctmfile.com or by following the links in our show notes. Let's begin today's discussion with the first story, which is about 5 large economies, the US, Canada, France, Japan, and the UK, agreeing to mobilize government-led investments totaling US $4.2 billion to develop a global nuclear supply chain. The decision was announced at the Net Zero Nuclear Summit at COP28 in Dubai, UAE. The 5 nations now backing the nuclear supply chain are collectively responsible for half the world's capacity for uranium conversion and production enrichment. They have recognized the need to develop resilient supply chains and to deliver safe and secure nuclear technologies. Ben, I thought this was a very interesting story. So I'd like to start this conversation by asking you, how do you think will the big 5 economies backed global nuclear supply chain benefit corporations operating in these countries?
Thanks, Push. Yeah, it's an interesting one for corporates. I think in the story it notes that this has the potential to help the move towards net zero and also kind of keep the global target temperature increase within reach. But to me, those sound like sort of nice side effects rather than the purpose of the announcement. I think clearly they're keen to eliminate reliance on Russian gas and oil for domestic energy needs and also, as it says in the story, cut Russia out of the uranium supply market as well. So I think the project needs to be a success because we've seen over the years recently, and particularly since Russia's war in Ukraine, the impact that even the threat of Russia turning off its energy supply to Europe has had on markets. And so that's where the kind of the corporate perspective comes in. For example, when gas prices spiked last year, initially regulators were looking for ways to protect energy companies from really significant margin calls. But since then, ESMA, which is the European Securities and Markets Authority, has issued proposals for another update to EMIR, which is the European Market Infrastructure Regulation. Now, EMIR impacts all entities established in the EU that enter into derivatives, such as hedging, commercial exposures, and other things. And it was the hedging that kind of tripped up the energy firms last year. Now, we're still waiting for EMIR Refit, which is effectively EMIR 2, to go live. That's scheduled for April next year in the EU and September in the UK. Now, the EMIR Refit was really important for all corporate treasurers in Europe because it removed the intercompany reporting requirements that were part of the first iteration of that regulation. So with the initial EMIR, use of a derivative meant treasurers had to report their transaction with the bank and the transaction with their affiliate, and also their affiliate then would also have to report that transaction with the corporate. So EMIR Refit simplifies the reporting requirement. The treasurer only now needs to report the transaction with the bank. But with the potential EMIR 3, these more complex reporting requirements could be put back in. That's something that they're looking at. And just to go back to the top of this story, the reason I'm mentioning that is the driver behind EMIR 3 came from this one event in one industry. It just happened that it was the energy industry, but now it's potentially impacting every treasurer in every industry. So if a move like this global nuclear supply chain can bring more security and confidence to the energy sector, that could be good news for all treasurers that are impacted by this.
Ben, you made some great points. From global nuclear supply chain, Let's shift the conversation to our next topic, which is about the European Union reaching a historic deal on the Artificial Intelligence Act, which would be the world's first comprehensive regulation of AI. EU's AI Act aims to ensure that fundamental rights, democracy, the rule of law, and environmental sustainability are protected from high risk AI while boosting innovation and making Europe a leader in the field. The rules establish obligations for AI based on its potential risks and level of impact, and also expand it to include foundation models, the advanced systems that underpin general purpose AI services like ChatGPT and Google's Bard chatbot. When you covered the story for CTMfile, what do you make of the EU's AI Act? And do you think the largest companies and their compliance and treasury teams in the EU will be under greater regulatory scrutiny over developments in, say, AI, data access, privacy, and security?
Well, I think overall it's good news because a lot of people certainly have concerns about AI. Artificial intelligence is only as good as the data and the people that train it. So all the rules that prohibit things like profiling sensitive characteristics of users, that's really important, as are the transparency requirements if people are going to be able to confidently use the technology. Now, there is also an element in there I noticed around sort of protecting the rights of smaller companies to develop their own AI as well. So there is an eye on innovation. It appears quite balanced at first look in that respect. I think for treasurers, obviously being able to make the best use of AI relies first on having a data strategy, as AI needs a broad range of information, like we mentioned a second ago, in order to train the model. So if treasurers want to use AI to improve their cash forecast, for example, they'll also need to integrate an API or APIs across the board in order to help bring all of their sources of data together. And then that structured data lets treasurers learn what's happened in reality, and then they can use that to help train the AI to make better forecasts. And I suppose another point is, obviously there's some worries about AI essentially making humans redundant in the workplace. But I think treasurers can be a bit more optimistic and maybe think about AI as a co-worker, but a co-worker that can sift through vast quantities of data in near real time and extract essential information. On the generative AI side, it's an opportunity for treasurers to ask questions such as, is there anything important I'm missing? And there might be an FX exposure that's unhedged somewhere around the world that, off the top of the data they can't tell, but the AI can immediately sort of bring that to attention. So I think there's lots for treasurers to be interested in, and kind of this regulation side of things, I think that's only going to help really in the long term.
Certainly going to help in the long term. Ben, that makes for an incredible perspective on the intriguing and evolving landscape of AI regulation. Moving forward to the third topic in today's discussion, which revolves around interest rates, the Bank of England and the European Central Bank have kept interest rates unchanged. The Bank of England's Monetary Policy Committee voted by a majority of 6-3 to maintain the bank rate at 5.25%. Three members preferred to increase bank rate by 0.25 percentage points to 5.5%. Meanwhile, the European Central Bank, or ECB's governing council, left the three key European interest rates unchanged. Ben, the Bank of England and the European Central Bank, or ECB, have kept interest rates on hold amid concerns over stubbornly high inflation. Do you expect interest rates to be cut next year amid cooling inflation so as to reduce high borrowing costs that are weighing on corporate growth and spending power?
Oh, that's the $1 million question, Push, I think. Yeah, we had obviously the BoE and the ECB announce on the same day that they were going to maintain a pause, and the Fed had done that shortly before as well. So I think that might have triggered the markets to make the leap that there will be no more hikes and start trying to position when the first cuts will come. But I think that's a little at odds with some of the quotes that came out of the monetary policy press conferences after these announcements have been made. The central bank's clearly still very focused on inflation. And while headline inflation has fallen quite significantly across the board, central banks tend to focus more on core inflation, which ignores the more volatile prices, things like food and energy. And core inflation has continued to remain relatively sticky. It's not falling at the same pace as headline inflation. And you can argue that, getting core inflation down to 3% is one thing, but fighting down that final stretch to get it to the 2% target that all these central banks have is much harder. It's the last yard. Can you make it? So it could well be that where the market predicts the first cuts will come, as well as the level of cuts that a lot of them are kind of pricing in for 2024, that could be overly optimistic. So I think treasurers have to think about the level that rates are at the moment and just sort of assume perhaps like a higher for longer policy. I think that's quite a popular phrase at the moment. So yeah, that's something to bear in mind on both sides of the coin, really. In terms of short-term investments, higher rates are pretty good in terms of generating a return. But also on the other side, on the financing and debt side, if you're facing a refinancing in 2024, say, I don't know, May 2024, I'd assume that the rates are going to be very, very similar to they are at the moment. So you need to plan for that. And obviously the costs that would bring to corporates that are able to negotiate a refinancing would be significant in that respect.
Interesting. Ben, let's move on to our next story, which is the 2024 outlook for global money markets, which is projected as neutral by Fitch Ratings. The neutral sector outlook for global money market funds is driven by the overall natural credit environment, the expectations of manageable industry flows, and the limited impact from regulatory changes. Fitch Ratings says in a report, drivers are expected to have different impacts in the US, Europe, and China. Ben, can you throw more light on Fitch Ratings outlook for the global money market funds in 2024 and its likely impact on corporate treasury?
Yeah, well, it's a good positioning of this story, Push. This is a good running order because it follows quite nicely from the previous conversation around interest rates. Because in that report, Fitch Ratings says it anticipates central banks around the world to hold rates until the second half of 2024. But like you say, it's a neutral outlook. On the plus side, when they did this outlook last year for 2023, it was a deteriorating outlook. Back then, they were very concerned with the worsening in the credit environment this year having a knock-on effect for the securities and sectors that money market funds invest in. So at least today, the predicted downward spiral seems to be pausing rather than continuing deteriorating. One thing I picked out of the report was its note that in the US, moves to increase liquidity thresholds and introduce mandatory liquidity fees might be bad news for prime money market funds. That could be troubling for treasurers because prime MMFs are a really popular form of investment vehicle. So, for example, while government money market funds invest at least 99.5% of all their assets in cash, government securities, and repurchase agreements that are collateralized by government securities, prime money market funds also invest in those securities issued by banks, corporates, and other non-governmental entities. So they don't only offer treasurers kind of a highly liquid and secure place to park that short-term excess cash and make market rates on that. They also invest in corporate securities on the other side. So anything that impacts prime money market funds could have a really significant impact on treasurers. And so kind of highlighting that as something US specific to look at, I think is kind of a valuable insight from this report from Fitch.
Ben, I like the way you've articulated a complex topic so clearly. I would now like you to please make your pick for the biggest or most important story of the past week and why.
So yeah, I was thinking about this and I think it probably is the interest rate story, and just for treasurers to have a little bit of caution around the war on inflation being won. Things definitely look good, a lot better than they did at the start of the year, but it's still, I think, a little early to be rolling out the mission accomplished banners and that there'll be no more rate hikes from the central banks. Like you said when we were talking about that topic, Push, the Bank of England in their vote, it was 6-3 and 3 members still wanted to increase by 25 basis points. That argument is still to be won before the first rate hike can be considered, specifically in the UK in that case. And I think there is maybe a little bit of difference between the US and the UK and Europe in that regard. I think maybe the US might be better positioned. But that's always something for treasurers to consider. Like we said, whether it's investments, whether it's the window for refinancing, or the whole other host of processes that have exposure to interest rate positions, I still think that kind of caution is the best way forward.
Caution is the best way forward. And I couldn't agree more with you, particularly given the as you mentioned, the higher interest rates regime expected to continue for a particular period. Well, we've come to the end of this podcast episode, Ben. A big nod of gratitude your way for your invaluable insights. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you so much and have a great week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.